capital resources for credit unions to advance racial equity in Black communities. This webinar is intended to share capital resources at Inclusiv as well as LISC. So this webinar is being hosted in partnership with Inclusive Black Communities, Inclusive Capital, and LISC. And we just want to make sure that, that these resources are available to many credit unions, but with an extra focus on Black credit unions for this particular webinar. But even some of the resources at Inclusiv are available for non-MDIs or non-minority depository institutions. So at this time, I'm going to turn to the next slide. And the next one, thank you. So today, I just want to go over the agenda. We have it broken out where we'll be hearing from presentations from Cathi Kim, the director at Inclusive Capital, on the resources for MDIs, again, minority depository institutions. And we'll also be hearing from two staff members from LISC, Tiffany Royster, Senior Director of Equity Investment Originations at LISC Strategic Investments, and George Ashton, Managing Director at LISC Strategic Investments. They'll be sharing their new information about their Black Economic Development Fund. In terms of housekeeping, I wanted to also say that you as attendees, you've all been placed in listen-only mode, but you're welcome to use the chat feature or the Q&A and submit your questions at any time, but we will be taking the Q&A, the questions at the end of the webinar. So after we hear from the two full presentations, we'll take the questions that you've been submitting throughout, and then we'll have a chance to just wrap up after that. This webinar is being recorded, and the recording and slides will be sent out to those who have registered, anybody who's registered within the week. So thank you very much, and I'll turn it over to Cathi Kim, who will share her information. Thanks, Cathi.
Great, thanks so much, Monica, and thank you everyone for making time to join us today for this really important conversation. We hope that the information and resources we share provide some really good opportunities and tools to you and your credit unions as you continue to lead and serve your members and your community throughout this inclusive recovery process. So again, my name is Cathi Kim, and I'm the Director of Inclusive Capital. And today, as we start this conversation, I'm going to first kind of walk through and set the table, do a high-level overview of what we've seen in the past couple of years, and really kind of going back to what our research and analysis has shown. And while it might not be news to everyone on the call today, but really what we've seen in terms of the unique impact and the leadership of minority designated credit unions, especially Black credit unions, in providing inclusive financial services and building more equitable communities. And so here, this is not news. You all have seen the statistics and read the reports many times over in the past year. And while this is not news to many of us, it was the first time that the nation as a whole had more of a national awakening to a lot of the systemic challenges that we noted earlier, whether it comes to the disparate rates of financial inclusion, especially in our lower income communities and neighborhoods, and then also specifically through the lens of race and the disparate sort of trend we've seen there, which then resulted in the disparate impacts of the COVID pandemic. So what we've seen with COVID is that it did not necessarily create new trends, but really just heightened the sort of gaps that we've seen before. However, we've also seen this, and this is just a high-level overview of what we've seen specifically with the community development credit union movement. And really, you all have been doing this work before the pandemic, but this is why community-based leadership, those that create products and services and are led by and for the communities they serve, are so important. You all are the leaders that are directly working with and are dedicated to undervalued communities and doing the hard work of helping opportunities become true outcomes. And we've seen this with your incredible and inspiring response to the COVID pandemic to make sure not only that your staff was okay, but that you're looking after the communities and really being able to reach deeply into those that were underserved, before the pandemic, and then also especially as the different COVID responses, such as the Paycheck Protection Program loan was being rolled out. And MDI credit unions have had such a critical role in making sure that those types of resources were effectively reaching small businesses and low-income communities, and also particularly communities of color, which we know that were not being as equitably financed before the pandemic. But cumulatively, MDI credit unions financed more than $346 million in these Paycheck Protection Program loans. And while those programs and these stimulus-related initiatives are important, we know that the road ahead is going to require more resources, and including capital, as well as development services that help meet people where they are so that they can continue to thrive and really help them realize all the opportunities that are before them and really support the leadership on the ground. And here what we've seen, and this is really thanks to the research team at Inclusiv, what we've seen is that even before the pandemic, you all were doing this work, especially those credit unions that have this mission, that are either CDFI certified, and then also particularly are minority designated. You not only talk the talk, you are doing the hard work. And in fact, MDI credit unions, out of all the different credit union segments that we analyzed across the industry, minority credit unions, those that are led by and for predominantly communities of color, they were the most financially inclusive in terms of the types of products and services that they're offering, including development services, and the reach that they have, that you all have, especially in economically distressed communities, are just a case of real true leadership and an example for the movement to follow. So now with the COVID pandemic, as our country and different states and communities are entering different parts of the recovery process, we don't know what the true impact of the COVID pandemic will be. That's one thing we know for sure. But really, what can we do now, and what can we learn from previous times of economic challenges? And so what we did was, at Inclusiv, is we looked back at what happened during the Great Recession, and while it was a challenging time for the whole country, but especially those that were underinvested to begin with, especially low and moderate income communities and communities of color, we've seen that the credit unions that had the mission of community development and financial inclusion and building more inclusive communities, they continue to respond to the needs of their members, as well as other community members and prospective members that were not being served by mainstream financial institutions. And net of net, what we saw was that those credit unions, in particular CDFIs, they actually came out stronger from the Great Recession. And as you can see here, I'm not going to go over all the numbers, but when we looked at their growth, their profitability, and then also you could see things like the provision expense. Again, this is not something that is done, very easily, but you all, with the sort of mission-centered leadership and the commitment to continuing to meet the needs of those that were not being served and focusing on financial inclusion, they came out stronger. And this was true across all the different peer asset groups, not just those that were larger, but also the credit unions that might fall under the smaller peer asset groups. Another thing that we want to spotlight was really how did this happen? And again, it's the leadership, it's also the business model, right? The ability of those credit unions, their commitment to continue to lend. And what were some of those precipitating factors? And again, this is just a sort of storytelling going back to what we saw and learned, what was successful with regards to the leadership and the thriving of inclusive financial movements, during the Great Recession, in particular, community development credit unions. There was an initiative during the Great Recession under the Obama administration called the Community Development Capital Initiative. This was under the larger TARP program, whereas TARP 1 was for Wall Street, TARP 2 is for Main Street. What we saw was that there were specific capital allocations for CDFIs, just like what we're seeing now with the Emergency Capital Investment Program, which I'll turn to momentarily. But what we saw with this program was that there was a real case study and a learning opportunity to really amplify what we've seen here at Inclusiv, as the first national lender of secondary capital. there was about $69.9 million in secondary capital that was invested in about 48 credit unions, CDFI credit unions across the country. About 40% of this capital actually went to minority credit unions. And what they did during this 5-year look-back window for which we analyzed the data, each dollar of secondary capital was leveraged more than 60 times into community lending directly into low and moderate income communities, which we know are disparately impacted during times of economic distress and hardship. Not only that, we saw that the types of loans that they were making were helping to build assets and wealth in these communities, from home ownership to providing access to credit, helping small businesses be created or to grow, general consumer lending to help folks have, for example, a reliable means of transportation, which is so important in many parts of this country that don't have a robust public transportation system. Not only that, something else that community development credit unions, in particular minority credit unions, do so well is about coupling not only the access to credit, right, with the loan products, but really also the development services that are so critical to helping meet folks where they are. And if they might not be ready for a loan yet, that you're working with them so that they are ready and they are able to move towards purchasing their first home, which is one of the most critical ways that the majority of US households are able to accumulate wealth. So on that note, just briefly, with this capital, the credit unions, the CDFI credit unions that participate in this initiative, were also able to either develop new development services, such as financial counseling, or develop new credit building loan products. So they're able to do both at the same time and really use this capital to really reach deeply into these underserved communities. And then here again, we did a separate cut just to focus especially on minority credit unions and to see their unique impact. And again, I'm not going to read all these numbers to you. You're going to get a copy of this deck. But what we saw was one of the 69.9 million and about 40% of the secondary capital actually went to minority credit unions. And then the asset growth here that you see below and the loan originations, there was, again, just so much compelling data and impact that was led by these minority credit unions in helping build community wealth. And again, just even looking at the figures from not only the total loan originations over, this is just a 5-year look back window, but also products like mortgages, which again support wealth building for most US households. And here's a quick snapshot. There's a lot of data here, but this is just to kind of walk through, high level, the types of development services. Some are new and some were pre-existing and were able to scale really thanks to the additional capital that was afforded to these credit unions through the secondary capital investments from the Community Development Capital Initiative. So that brings us to where we are today and what we saw in the past year. And this is just kind of doing a comparison between 2019 and 2020. And overall, for the entire credit union industry, it's been a year of extraordinary growth. But for minority credit unions in particular, what we've seen is that I'm going to spotlight just a couple of things. You all are experiencing this. And again, this is for the full set of minority credit unions. I know that some of you might be experiencing higher growth rates in some areas and lower rates in others. But as a whole, as a collective, what we've seen is just tremendous growth because of the trusted leadership and the awareness of the type of deep impact and financial inclusion work that minority credit unions do, especially in terms of advancing racial equity. We saw that there's tremendous growth in shares. There's continued growth in loans as well, but that was outpaced by the growth in shares and assets. Capital in terms of equity also continued to increase by about 6% in the past year, but as we noted, it's a bit lower than it was in the previous year, and it's being outpaced by that growth in shares. And so what that signals in terms of capital opportunities and needs is this need for additional equity capital to sustain that continued growth. You've already demonstrated really from the growth in shares and new members coming into the credit union, those opportunities, but how might we at Inclusiv, and then also the sort of circles of partners like LISC, really help support the leadership and not just the survival, but the true thriving right, of minority credit unions, especially in expanding financial inclusion in underestimated communities, in particular, communities of color. We know that this is so important, especially with the national racial reckoning. And also for the economy, trillions of dollars are being lost because the full opportunities are not being invested in particular with Black communities and other communities of color. So that brings us to a couple of resources that I'm going to walk through briefly. And again, we can take additional questions in the Q&A. But in addition to the CDFI fund grant programs that were launched and enhanced through the stimulus appropriations bill that was passed in December 2020, overall, the stimulus package included $12 billion in capital specifically for CDFI certified credit unions, as well as minority designated depositories. Of that $12 billion, $9 billion in capital is being allocated for the CDFI and minority depository institutions. And that for us, and why does this matter? Why am I bringing this up? This could be a source of secondary capital, which counts towards your net worth. And so it would address some of the capital constraints and opportunities I mentioned earlier in this slide, where you all are growing your capital, your net worth, but you might be interested in more really to keep pace with and being able to retain that share growth, right? So that's going to be a resource for you all to consider, especially in terms of ALM and thinking in the future about potential growth strategies and opportunities that you are faced with today. So here, again, there's special capital set-asides, especially to, I think, in attempts to make this more equitable, especially for the smaller institutions. And so for those of you who are minority designated or CDFI certified, you will be eligible to participate in this program. The deadline is May 7th. And we at Inclusiv have been working with credit unions across the country, really, in leveraging our secondary capital expertise with the regulations and also prior experience with CDCI to help make sure that the credit unions that are eligible and interested are able to access what is a real watershed moment and opportunity for the movement. And what we saw from CDCI is that investing capital directly into the capillaries of these communities, the leadership that's already there, that can have a tremendous impact in helping build assets and wealth in communities that have been overlooked by mainstream institutions. And here, I'm not going to read this all to you, I promise, but you can see like really high level what the rates and terms are and why this might be a resource for you all to consider. Again, while it is a loan, it's counted towards your net worth. And so that's going to help increase the capital base for the credit union to give you more room to grow, but also innovate new products and services, expand your field of membership, and just so many other opportunities that I mentioned earlier in the CDCI. And again, happy to answer any other specific questions you might have regarding uses of secondary capital. But it's long-term capital. The interest rate's about 2 or 2.5%. Which is more than a deposit, but it's also because this is being used for a different purpose. It's not just liquidity. This is capital that can be used to strengthen your equity position to allow you to grow, especially in a time of uncertainty where we have not yet seen the impact or the fallout in terms of delinquencies or material increase in net charge-offs. But there's a bit of uncertainty. And so you might have already taken a provision expense in 2020 just to have that additional capital cushion as we kind of move forward through what will hopefully be a more inclusive recovery process. And here's just a really high level overview of what the eligibility requirements are in order to apply for the Emergency Capital Investment Program. And at Inclusiv, as I mentioned earlier, we do provide some technical assistance through our capital program, as well as through our annual lending certification report services and loan analysis that we do for all of our members. And so lastly, what I'm just going to spotlight is another capital resource. In addition to Treasury, Inclusiv also has secondary capital resources that we make available to our members or potential members. And really, Inclusiv was the first national lender of secondary capital, and our previous leadership was part of the circle of advocates, really championing especially for additional capital resources to support financial inclusion, in particular in low income and under invested communities. And what we are really excited and privileged to be able to offer, especially to our minority credit unions and those that are either led by or serving predominantly communities of color, is secondary capital at rates that are pretty comparable to what Treasury is offering through ESIP. And so that's secondary capital with rates starting at about 2% for up to a 10-year term. And really, this is for a limited time. Historically, we've offered below market rate terms on secondary capital. But here we're able to bring down the rates even lower thanks to our advocacy and our circle of impact partners and that we've been working with, really because of the work and the leadership you all have demonstrated before the pandemic, but especially during these times of uncertainty. And so here's just a high-level overview of the term sheet. We have a couple of different funds through which we are offering secondary capital to, again, this is to help advance equity in communities of color, in particular, also Black communities. And we're doing this through two initiatives, which you may have heard about starting last year. And it's related to the Inclusive Resilience Grant Fund that Monica and her team have been leading. But we have the Inclusive Racial Equity and Resilience Fund, through which we're offering secondary capital of up to $2 million to minority designated credit unions and those that are led by or serving communities of color. The loans are up to 10 years, starting about 2%, up to 3%. And then also for those that might have larger capital needs, up to $5 million in secondary capital, we're able to provide secondary capital through our Southern Equity Fund, which we launched in 2019 in partnership with a very diverse circle of investors and partners, really for the purposes of advancing racial equity in the American South. There are some carve-outs that we could fund other credit unions that have racial equity initiatives. You don't necessarily have to be minority designated to participate, but we are looking to partner with credit unions that do have an explicit financial inclusion and racial equity initiative. And this is the first impact fund ever that was created for credit unions and really for this explicit purpose of advancing racial equity. And really high level again, I know this is a lot of information to process, but for folks on the line who are not familiar with secondary capital, again, as I mentioned earlier, is different from a deposit, and you do have some regulatory plans and processes to kind of develop and go through. And here at Inclusiv, just as part of our capital program and our role as a CDFI, we provide technical assistance to our members to help work with them through this process. We see our investments not as a transaction, but just like how you view your loans to your members, we see this as a partnership to really support your leadership and the impact that you all have had on, continue to have on the communities that you serve. And so happy to take additional questions about this later. But with regards to the regulatory requirements, those of you who are state chartered will have some additional requirements and you want to consult with your state regulator. But from NCUA's perspective, you have to submit something called a secondary capital plan. These are the 5 key baseline sort of requirements. 1, to state how much you're seeking in secondary capital. 2, what the purpose of the loan is and how you're going to repay it. And you can see the other points there. And again, happy to take questions on this or speak with folks offline if you have any questions about this process and how Inclusiv can be a resource there. And lastly, just a real high level sort of recap again about secondary capital and what we've seen from CDCI as well as Inclusiv's own lending partnerships and how secondary capital can be used successfully. We know it's not just about the loan, but it's the capital plus your leadership, plus your impact model. And really what we've seen as successful uses of secondary capital is that it can be used to help expand the community impact and services to, in particular, to underserved communities, whether that's a new type of community partnership you might be working on with local organizations, developing new products and services that are designed to be more inclusive of those that are being underserved, whether it's helping meet a need for anti-predatory loans or more affordable home ownership opportunities. Whatever the case might be, you know your community's best, but we've seen tremendous impact of our secondary capital partners and using this capital to do this work. And also a more fuller integration of the community development initiatives into the credit union's larger enterprises and strategies, innovating and scaling loan products and development services that are designed for low income and marginalized communities. In addition to that, we have seen secondary capital also be used to successfully engage unbanked or underbanked communities, whether it's through a field of membership expansion, opening a new branch in a financial desert. There have just been so many incredible ways in which the CDCU leaders, and in particular minority credit unions, have successfully used secondary capital to really advance their shared mission. But then also from the financial perspective as well, share with you just the trends that we've seen in 2020, but then also prior, where we have that classic sort of ALM scenario where you all are growing, that shares are growing, loans are growing, but the ability to retain capital or the capital growth might still be positive, but might not be at the same pace. And so secondary capital can be a bridge to help equalize those two growth rates and help you and your credit union really move forward towards the long-term financial growth, but also the community impact and reach that you all have demonstrated so well and are real, I think, beacons for the movement as a whole and the credit union industry as a whole to follow. And I think something for the country to consider, especially as we think about really how might we address the issues, especially around racial equity that we have collectively awoken to, and really how do we also support, be innovative, but also support the solutions that work. And we know that it is the community development credit unions, in particular, the minority credit unions that have demonstrated just tremendous ability and leadership in being able to reach deeply into communities that have so much opportunity and have such rich histories, but really, unfortunately, have not had the full capital to help them realize all those opportunities and translate them into outcomes. So I'm going to pause there and stop my screen share, and I'll turn the mic back over to Monica and Tiffany.
Thank you, Cathi. Thank you so much. For anybody who has any questions for Cathi, feel free to type them in the chat or the Q&A, or you can ask them at the end. But if you don't want to forget your question, feel free to type it in now. I'm going to turn it over to Tiffany Royster from LISC to talk about the Black Economic Development Fund. We know that you announced it a while back, and so we're very excited to hear the details of this program and share with our members. So thank you.
Sure, thank you, Monica. And can you see my screen? I just want to make sure I did it right, Monica.
Yes, I can see it. We can see it.
I just need to do slideshow, but what I want to say before I get started is thank you for having us here. And George may be somewhere here in the chat room trying to find his way in. So hopefully he'll be able to join us. But I work with LISC, and I'm the Senior Director, as was mentioned, Equity Investment Originations for the Strategic Investment Group of LISC. And I wanted to give you a little bit of background on LISC as we get started here. And I did this right before, and I was able to do slideshow, and now it's failing me. But I'll go through this way in the interest of time. So
Tiffany, down at the bottom, if you at the footer, the little presentation, the right one next to it. Yep, that should do it for you.
Thank you very much. I had it on this screen and then I had to take it off to share. So thank you. And so again, I'm with LISC, and we're here to talk to you about the Black Economic Development Fund Beyond Deposits program. But before we do that, we did want to, at least give you a little bit of background on LISC. And so one of the things that is our big focus right now is an initiative we launched called Project 10X. And the reason why we launched that program is because if you look at the median wealth of white families, it was 10 times that of Black families. And so we said, as an organization, what can we do to help decrease that wealth gap? And so we're raising $1 billion in grants, debt, equity to address that. And the Black Economic Development Fund is part of that 10X initiative. And so as we talk about it, you know, we're trying to make sure we have capital that's flexible, that's nimble, that's creative. And the reason why is just so that we can be most impactful to the community served, to our partners, such as you guys, that we may work with to help decrease this wealth gap. I know we're all in this together. And so, you know, some of the things that we'll invest in is generating lasting equity and wealth through home ownership. We want to support programs that bring quality jobs. And then of course, community health, digital access, education, arts, and justice. We have a big focus on the BIPOC community. And as such, we want to work with BIPOC-led financial institutions or groups that are focused very heavily in the BIPOC communities as we work on that. One of the things I should mention about LISC, we usually have a slide in here that gives you a broad overview. For those that don't know, we have 36 local offices around the country. Those are our boots on the ground. Many of you may work with them already. Since 1979, we've invested $22 billion. But the great thing about that isn't necessarily just that we invested the $22 billion, but that $22 billion leveraged $64.8 billion for community, retail, commercial spaces, and then also just services and programs to the community. And so when you talk about leverage, that's what the Black Economic Development Fund can help us do, is leverage our resources, but also leverage our partnerships to bring forth the best solutions for the community. And so with the Black Economic Development Fund, what it is, it's a mission-oriented fund. It's focused to support Black-led financial institutions, community centers, anchor institutions. And the goal, the fund is mission agnostic, is industry agnostic, certainly not mission agnostic, it's industry agnostic. And we want to deploy capital across a wide set of borrowers and geographies throughout our footprint, throughout the footprint of our partners that we're working with, so that we can close this racial wealth gap. And some of the ways that we look to do that is let's invest in Black-led businesses. Let's invest in Black-led developers. Many of the developers have access to capital issues, and they're doing great work in the trenches, in the community. And so we want to help that and help provide capital that is best suited for that. Another thing is Black-led financial institutions, CDFIs, such as many of you guys who may be in this presentation. And then Black-led anchor institutions, which could be educational facilities or other institutions as well. And so I know I'm breezing through this. I want to make sure we have time for questions at the end. So please put them in the chat or write them down, but I want to make sure we get to the meat of what the program is. So with the Black Economic Development Fund, while it's doing a wide range of things from, you know, various loans to businesses to educational institutions and that type of thing, we wanted to make sure we didn't leave out, you know, Black-led financial institutions. And so what we said was that, what can we do to help the credit union and MDI communities? And so we came up with a program. Many people say, let's put deposits in. And some of you guys have received deposits, and that's something that we're looking at as well. But we said, let's get beyond deposits. So that's what we came up with, beyond deposits, because we recognize that deposits are just one part of your balance sheet and it's a liability. So this chart here, this page here lets you know that we see you and we understand the composition of your balance sheet. And yes, we want to help with deposits as needed. And we want to help you with customer acquisition, because we're not a bank or a credit union. So we don't want to acquire the customer, but we want to do whatever we can to help you with your customers. And then another thing is that as you look at the assets, we said, okay, we could do loan participations. You know, some of you may have loans that for a concentration reason or out of market or any number of other reasons, you can't do the whole loan, or you can't do the loan, but you really want to keep that customer. And so in that instance, we want to help provide capital and participate in those loans with you so that you can keep your customer. And say the loan grows, you know, your customer used to do loans that were $1 million. Now they're doing loans that are $10 million. We can step in to help you retain that customer by filling that gap that is above your legal lending limit or that type of thing. And then also co-investments as well. We're happy to co-invest with you. And then also, as we see loans in your market that might fit, we're happy to participate those with you as well. Our fund does not have equity, though we've worked very hard. There are many funds that do have equity. And so what we want to do is be a good partner there. And when we see equity, whether it's from our investors or from other funds that we work with, we will refer that to Black-led financial institutions as well. And then just some brief things. When you look at the products that I outlined on the previous tab, you know, when you look at loan participations, some of the advantages are, you know, customer acquisition. We want to help increase the non-interest income because we know that's key, and to help with to survive the shocks and stressors of different market changes. Helps with decrease in interest expense, and then loan growth upstream, and you know, improvement of concentration of portfolio. You know, now with this target, we're looking at loans over $1 million. We're looking at terms under 5 years, and then we put the rates here, the yield requirement, just because that's important to note. You know, 3 to 5% on real estate and 5 to 9 on business. Obviously, all of that is dependent upon underwriting. We really want to push the envelope, which is why we're trying to get up to 90% loan to value so that we can push the envelope there with the loan underwriting requirements. And I know you can see the things on the page, so I don't have to read it all off, but just wanted to give you a brief summary of some of those things. Co-investments, you see many of the same advantages, but one of the things to note is that with the co-investments, you have the benefit of a lower rate by blending the rate. And so that can help with competitiveness in the market. And then, you know, as through all of these, we stress customer acquisition because we aren't a bank, you know, so we just want to help you retain your customer, and we want to help you acquire more customers. And so that's the main important function for us. And then loan purchases, which is something I didn't mention previously, but we're also willing to look at loan purchases. We understand that as you configure your portfolio, often there may be a need to sell loans. And so we're willing to look at loan purchases. We understand that that could be helpful from a liquidity standpoint, interest spread, and then we're happy with you retaining the servicing because, you know, again, we're not a financial institution. So you can retain the servicing. We can help you by purchasing the loans. And then you can redeploy that capital elsewhere to further your mission. And then here we have what the targets would be and the underwriting requirements, and looking from a servicing perspective at 25 basis points. And so deposits, we saved that for last, but obviously we're very happy to do deposits as well as needed to help, you know, you feel your loan growth and your programs as you're working in your communities. We're looking at sizes of over $1 million when we look at deposits. And though we may have a term that's not greater than 2 years, we want to stress that our goal is for those deposits to remain with the institution for the life of the fund, which is 7 years. And so we may set a term and then renew at that term just from a liquidity standpoint. But our goal is to really stay with you for the life of the fund. And then hopefully after this, there's another fund and we can do more work with great partners. And for the pricing on that, we've been looking at 10 to 25 basis points in the market with the deposits that we've deployed thus far. And then right here, what we wanted to do is give you an example of all the ways this product could affect a project, and then how how you as a partner could benefit. And so this is a project in DC that is a mixed use project. It has commercial, it has residential, it has senior affordable housing, and it's right in Southeast DC, near the one of the mayor's offices and DHCD. So when you look at this, there's so many banking opportunities, financing opportunities that are created from this. So you can have a pre-development loan, you can have senior debt, you can have deposits accounts, not just deposit accounts from the developer, but deposit accounts from all those businesses that are located in the property, and also from those residents. Then you have the permanent jobs that are created. And so this is a way where we see there are many financing opportunities that are created that we can share with our partners, such as yourself. And then, of course, that benefits the community from an investment standpoint, from a rehabilitation of a community standpoint. You have business growth, you're creating income, you're generating wealth, not just for that particular company, but for the families of that community. And so that's something that we think is very important. Quickly, I know I said we have 36 local offices. You guys can ask us about this later, but this page just gives a very quick snapshot. I know that this PowerPoint will be available after this presentation. And then we did a map so you can see where our local offices were. And then this is our contact information. In the interest of time, I tried to go through that quickly, but we're happy to be here, happy to answer questions, and thank you guys for the time. And with that, I will stop sharing. And Monica and Cathi, thank you for helping me with my technical issues with figuring out the slide share.
No problem. Thank you so much, Tiffany. That's really great information about LISC and also about the fund. I hope that people are getting their thoughts together and questions for you. Earlier, we were getting some questions in for Cathi, so I'd like to, bring Cathi back in. And Cathi, we had a couple of questions during your portion where people were asking about how do you define financially excluded communities? And I know that you might have, responded in the chat, but just so everybody else can hear the response. So how do you define financially excluded communities? And is it safe to assume that you consider these communities banking deserts?
Yeah, no, thanks so much for the question. I think it's a good one. I think there's like a high level sort of overview and commonalities, what we're seeing about, how we, define what the problem is and, what financial, exclusion looks like. And then I'll share some like more detailed stories, I think, around how some of our members kind of have their own sort of specific metrics. But I think overall, like really high level, we look at data such as the unbanked or underbanked rates, meaning that either we're looking at financial deserts or banking deserts. There are still communities in this country that actually don't have any mainstream financial institution present. And so what we have, for example, I think in communities that are served by our member out in Utah, Alabama, is that there's a prevalence of payday lenders and alternative financial services, but there's no bank or credit union. And so I think that's one example. There's also areas where you might have some financial institutions, but a really high underbanked rate, meaning that people, and there's a really high correlation, I think, across income, and then also, unfortunately, race, when we look at the disparate rates of being underbanked. And by underbanked, and you could see the actual data for different MSAs, if this is of interest to you, in the FDIC's biannual like economic household report, and also specifically, oh my goodness, it's blanking me right now. Sorry, the FDIC report, where you can kind of see the different unbanked and underbanked rates for your community. And then also I want to spotlight Prosperity now. I know I used to work with them. They also have specific analysis, and it's just the data is presented so beautifully and so like easy to read, really kind of spotlighting the disparate trends across race. So I think that is a really great resource. We look at other things as well, such as the poverty and unemployment rates. And again, as I mentioned earlier, and this was part of how we came to develop the Southern Equity Fund I mentioned earlier. But when you look at the landscape and different maps, right, where you see a prevalence of predatory lenders, such as payday lenders or different types of alternative financial services. I think that's been one sort of like commonplace in where and how our movement has defined or come to, identify financially excluded communities. I would also look at just things more like nuanced data that some of our members also look at in terms of like, equitable financing. Sometimes, when you look at the actual like, per capita, distribution rates and the demographics of the community and seeing who's getting capital, whether it's for small businesses or mortgages. I think that's something else that a lot of our members look at and trying to see where there are unmet needs. And then for us as CDFIs, really, we see those as opportunities.
Thank you very much. We do have a couple more questions. One question is, do the secondary capital loans lead to an increased funding need and or use for wholesale funding? So I don't know if you thought about that, but.
Sure. John, can you clarify the question in the chat? I'm going to try to answer it. What we've seen with secondary capital is that it does lead to the continued growth. The institution's generally growing beforehand, but then it's catalyzed by the additional secondary capital or equity, right? And that in itself does open the door to either, for now, if I were looking at, if I were leading a credit union, looking at the opportunities now, kind of supporting that really historical levels of share growth that we've seen. But I think going forward, right, if you have the additional capital and then you have the increased lending, some credit unions do use as an opportunity, I think, to really, they might take on additional non-member deposits or really kind of use that as a longer runway to do other sorts of, growth strategizing around field of membership expansion or opening new branches and then getting in more core deposits that way. So I think it depends on the strategy of the credit union. But there have been instances where I think folks were, for that interim period, sometimes you might need a bridge where your lending is increasing faster than your ability to get deposits. That's where I think that sort of additional funding need might come in. But again, it's going to depend on the credit union. And right now, I would just kind of put a pin in it, just given the really historical rates of share growth that we've seen. I think for us, and Tiffany mentioned the deposits program that's included as part of this Black Economic Development Fund. And we see them here at Inclusiv. We have an impact deposits platform. And right now, there isn't a universal strong need, but what we've seen in the past is that, especially kind of given the deposit core base, especially for the credit unions that are serving predominantly low-income communities, usually the average share balance is lower than the average loan balance. And so there might be a need, but again, it might depend. Great. All right. Thanks, John. I'm glad it answered the question.
We were gonna give him access to speak, but it's glad you were able to answer that one. I'm gonna kind of split this question for both Cathi first and then Tiffany. But the question is, do you reach out to institutions to make them aware of the secondary capital programs? Like, do they should they approach you or NCUA about these?
Yeah, no, definitely. If you know of any institutions or if you're on the line today and you want to hear more, contact us. My colleague Ahmed Campbell, our Director of Lending Development, and I, we would be so happy to speak with you. In terms of inclusive approach, there's more than 500 MDIs. We haven't had a call with every single one of them, but we do outreach. And we also have been hosting webinars both with Inclusiv's platform and also industry partners. But definitely, if anyone is interested, please email us. We would love to hear from you.
And the same for Tiffany. How have you been letting credit unions know about this? Should they approach you? Or not institutions, the financial institutions?
Yes, and so we reach out to people through my group. My team, we've reached out to people. Our local offices reach out to people and have relationships. But we love for people to reach out to us because obviously we try our very best to get to everyone. And there's so many people, there's so many institutions, so that's not possible. So we very much welcome you reaching out to us, particularly if you've heard us speak somewhere and you have a question about a specific product. It's great when you come to us. It's really helpful. So I know the presentation will have all my contact information in it. So feel free to use that as you would like.
Mm-hmm. And just in general, are there any things in terms of, I have another question that came in, but just while you guys are thinking about this and you know, approaching and people approaching you, are there things that they should gather together if they were going to have a conversation with you? Like, should they have certain like loan stats, or, you know, kind of compiling like what they would use the money for, or just, I don't know, like what kind of, in an initial call, what do they need to think about to prepare themselves?
I mean,
to make it worthwhile, you know?
Yeah, for us, obviously, it's important to know when we're talking about different products, you know, how the product might be useful for you, or if you have a particular loan that you want to talk about, or a particular small business that you want to invest in. That's helpful. We also enjoy the conversations where you're not quite sure exactly, but you feel like there's some synergy, because what we found is that when we talk to you in those conversations, sometimes it may not be the Black Economic Development Fund. I mean, it's you know, over $200 million fund, and so it's a great resource, but it may be some of the resources at our local office, or it may be some of the resources at one of our subsidiaries, you know, like our NEF, which does low income housing tax credits, or our new market tax credit group, or even some of the work we're doing in small business. We're working on raising funds for that, or it could be also we're looking at tech. That's something that we're investigating, how we can bring tech to MDIs via financing that is feasible for the organization. And so in those conversations, you may bring up other things besides the product, and it may be very useful for us to have those conversations and brainstorm together. So we appreciate that.
And then same to you, Cathi. Is there anything that you like to have folks think about before they reach out to you?
Yeah, no, I love the question. And plus one to what Tiffany said, and I think that's something that we share, right, with both LISC and Inclusive being CDFIs. It's not just about this transaction or this loan. We're here to really help support your leadership and advancing racial equity and financial inclusion. That's our shared goal. So we want to start that relationship with you and kind of go deeper, understand what your needs are. If you can share, you know, just things that are top of mind or what might have interested you in this secondary capital opportunity, that would be helpful. But for us, it's almost like it's a relationship, right? And it could be kind of like a first date. Maybe you don't know like what you want, but it's just something about it resonated with you. And we're happy to kind of walk through like our assessment, or even have a very baseline conversation about what secondary capital is. We've used different approaches. We just want to, you know, have this opportunity to kind of speak with you, learn more about your work at the credit union, and see what the synergies or opportunities might be. Maybe it's going to be secondary capital, but as a CDFI, and, you know, Monica's side of the shop leads the programmatic work. And so it might be, you know, working with her team, or perhaps it's both, but I think it just starts with the conversation. You don't have to worry about having your 10-point strategic plan ready. Later on in the process, you do need a strategic plan, you know, as I mentioned about like the regulatory process, but really just give us a ring, send us an email. We want to hear from you and see how we can help support the tremendous work you're leading in your communities.
Okay, that's wonderful, great. I'm glad you guys are open for those conversations. We'll take about maybe 2 quick questions before we wrap up. We're reaching the hour, but one question came in about, for this, I think this one's for Tiffany. Does the customer acquisition support include non-commercial members? So you mentioned customer acquisition. And so does it
yeah, and so when I said customer acquisition, what I meant there is, so in your market, there may be a customer that's doing transactions that are larger than what you're able to do. But you have a relationship with that customer, but you don't have you're not able to do that because of your legal lending limits or that type of thing. We're happy to help provide the financing so that you can do that loan. We just participate in it to help you get the amount that you need, so that you can then, that customer can be your customer. And so that's what we meant. As far as like direct customer acquisition, if it's like deposit customers, we don't do that in a direct way. Obviously through the projects, hopefully there are deposit relationships that come out of that. Some of the things we're working on in our MDI tech space, which is very, very early stage, that could be a product. We could be helping finance tech that does customer acquisition, but in particular to this program, the Black Economic Development Fund, what we meant was helping you access loans with different customers. And that could be a small business customer, that could be a real estate customer. We have many developers where they are seeking pre-development or mini perm, or sometimes capital to kind of refinance. Capital is a little bit more expensive to help them expand and grow what they're doing. And so that's the type of customers we're talking about from an acquisition standpoint, and retention, to the extent that you have customers that have grown upstream and you haven't grown at the same level. We're happy to help fill that gap.
All right, so for the last question, and thank you both for all your time. The question came in about funding. So the question is essentially, where do you get the funds to keep these efforts funded? Are they government grants or private funding? And I'll start with Cathi and then maybe Tiffany next.
Sure, at Inclusiv, we work with a diverse cohort of funders. It comes in through different sources. We're a CDFI, and Inclusiv has been successful in getting CDFI awards in the past. But a lot of this is capital, and investment capital that we've gotten from different banks, foundations, socially responsible trusts, impact investors, and religious institutions. Our first set of investors, and for many CDFIs, and we concluded Women's History Month, were actually nuns, like Sisters of the Orders Religious. These women are more than just people and habits. They do good things and radical things with their pension funds. So I could go on about that separate conversation, but so much to say about the leadership of nuns in the space as well.
Great, thank you, Cathi. And Tiffany, about the fund, how is it being funded?
Yeah, so LISC is a CDFI as well, and we're the largest CDFI depending on how you do the math. And so obviously we raise capital in the ways that many CDFIs do, but we also have our NEF, National Equity Fund, which does low-income housing tax credits, New Market Support Corporation. And so our CDFIs that generate capital also provide resources to our mothership, as we call it, the main list, so that we can use those resources to do this great work. But then also we raise capital from foundations, from corporations. The Black Economic Development Fund is mostly corporate sponsors that have provided this capital. I'm not sure if I can name names. I don't want to get in trouble, but when you go to our website, it does name names of many of the funders. The big one that everyone knows is Netflix, because that publicly came out. So I can say that we just had an announcement of Wayfair being in the fund, and there are many others like that. And so that is also a place. So it's all of those things, as I saw in the chat, from governmental to foundations to corporate. And I think as CDFIs do this work, it's important to diversify where your capital is coming from. And so we certainly do that, so that we can make sure we keep providing not just capital, but we keep pushing the envelope, because sometimes capital is provided in the market and it's too expensive or it doesn't work. And so we're constantly trying to figure out, how do we get capital that actually is the right price, so that we can be most beneficial and most impactful, catalytic, all those buzzwords that people like to use these days.
All right, so that brings us to the close of this webinar, but I hope that our attendees, got something out of it in terms of just understanding what is available and just, high level. I know it's just the tip of the iceberg, and I really appreciate that you guys have made yourselves available for future conversations with our credit unions. So thank you, Tiffany from LISC and Cathi from Inclusiv. Everybody have a great day. So thank you so much.
Thank you. Be well, everyone.